Well, people, how are you? I hope you are doing fine wherever you are. Yes, I am the Acca tutor, Mr. Mtimkulu, and I'm glad to take you through this session where we are going to look at property income. Yeah, this is part of income tax and national insurance contributions series or topic. Yeah, it's just part of the same income tax computations series. So, in this video, we'll be looking at computing profits, reliefs, and restrictions for individuals. All right. So this is why I said it's part of the mainstream income tax, right? The mainstream income tax computations. All right, remember that was our first video. Our first lecture where we got oriented on income taxes. All right, for individuals in the UK. Remember, we are going to be guided by the Finance Act of 2025. So this video is relevant to those who are going to write in June, September, December, and March 2027. They will be rightfully guided by this video. All right. Without much ado, ladies and gentlemen, let us get straight to the business. Now, the learning objectives are that by the end of this session, you will be able to compute property business profits using the cash and accruals basis. All right, so you should be comfortable computing proper business profits using both methods. You should be able to apply the rent a room relief. This is always going to be resident in our examination. Calculate the property income element of a lease premium. Navigate the 20% tax credit restriction on residential finance costs. And lastly, utilize property business losses effectively. So these are our objectives. If we give solutions to these objectives, then we are going to pass everything related to property income in our upcoming exams. Now, the basis of assessment, this one is just a repetition because we touched on this aspect in our initial video. Now, the tax here in the UK, income taxes are assessed on the period 6 April to 5 April the following year. So 6 April this year, okay, and the year is going to end on the 5th of April next year. The aggregation rule. All properties owned by an individual are treated as one single business. So when you are computing these property incomes, you need to ensure that all the properties are brought to one place because they will be considered as just one single business. Then the default method, the cash basis is the automatic default for individuals or partnerships unless receipts exceed £150,000 or the taxpayer elects for the accrual basis. All right, so if the receipts are less than 150,000, and even if the examiner did not tell you that this guy is using the cash basis, you should assume the cash basis is the one to be used. So you need to adopt the cash basis. Always assume cash basis unless the question says otherwise. That's the exam trick. Now, let's start with the cash basis. Now, if you are using the cash basis, rental income is, uh, to arrive at taxable property income, you just have to say rental income received, received. Please, received simply means that the actual cash has entered into our bank. So rental income received minus related expenses paid. Paid, which means there was an actual outflow. Actual inflow minus actual outflow. That's the formula. All right. Now, timing. When the cash hits the bank, that's the idea. Because if we are saying rental income received, we are actually saying when the cash actually hits the bank. The period the rent relates to is irrelevant. Sometimes you may be told that the rent which was paid this year related to the rent which was supposed to have been received last year. So you then be confused to say, oh, shall we then tax this because it relates to the previous year? No. The moment that money comes, as long as it is for rental income, it is going to be taxed in that year where it is received. Where it is received or where the relevant expenses are paid. That's the idea. So the period to which the rent relates is irrelevant. Bad debt. This one is not an issue. If you didn't receive it, you are not going to be taxed. All right. So bad debts in the cash basis system are irrelevant. You need to ignore them. What about deposits? Security deposits are not income. They are liabilities to be retained. So again, these ones, you must not worry about them. Why? Because they are not your money. Yes, even if you received it, but they are not your money. At one point in time, you have to retain those amounts. What about deductions? The cash basis property income. Now, the rules here broadly follow trading income principles. The general rules: expenses must be wholly and exclusively for property business for them to be allowable. They should be wholly and exclusively. So this is why we say that the expenses paid have to be related to the rental income. Examples of allowable expenses are insurance. Yeah, the insurance on the property is going to be allowable. Agents fees and management costs, these ones again, because we are always going to use estate agents for us to run the property business properly. uh Repairs, the repairs are going to be allowable. The loan interest, the loan interest that is for non-residential property is going to be allowable. But if it is a residential property, special rules are going to apply with regards to interest costs or finance costs. Special rules are going to be applied. So this means that you are not going to deduct the finance costs directly from the income because there are special rules if it is a residential property. But if it is commercial property, then you will be allowed to deduct directly those interest charges. Special considerations: pre-letting expenditure. Sometimes you incur expenses before you start to offer your property for rentals. These ones are allowed if incurred before letting begins. Must be meet must meet pre-trading rules. That is, any revenue expenditure incurred in the 7 years before a business starts to trade, which would have been allowable if the business was trading, is treated as an expense on the day that the business starts trading. So if you incur those expenses within 7 years, And those expenses were going to be allowable anyway. If you were already trading, then you'll be allowed to deduct them. What about private use restrictions? If owner occupies property part year, then the private portion is not going to be allowable. That private portion is not going to be allowable. Any expenses that relate to the private portion occupied by the owner are not going to be allowable expenses. What about capital expenditure? This is subject to separate rules, not generally deductible under income rules. So we need to then look at the rules which apply to capital expenditure in the short moment. Let us look at this example. Luke owns a property that was let for the first time on 1 July 2025. The rent of £5,000 per annum is paid quarterly in advance on the first of the month. Luke paid allowable expenses of £200 in December 2025 related to redecoration following a burst pipe, and of £400 in May 2026 related to repair work which was completed in March 2026. Calculate Luke's property income for the tax year 2025-2026. Okay, now we just have to be comfortable here with the aspect of dates, because dates do matter. All right, so the property was let for the first time on 1 July 2025. All right, and the rent was for the whole year. Okay, the rent of 5,000 per annum is paid quarterly in advance. All right, so the 5,000 relates to the period 1 July to 30, excuse me, to 30 June 2026, 1 July 2025 to 30 June 2026. However, our tax year is going to end. The tax year 2025, tax year 2025, 2026 is going to start on 6 April 2025 to 5 April 2026. So this is the tax year, this is the rental year or income year. All right, so you as the tax practitioner, you need to ensure that these figures do not conflict. Now, let us get back. We understand that there are 4 payments which relate to this 5,000. The first quarter payment, second quarter, third quarter, and fourth quarter. All right. All these are going to be applicable. All right. Now, let us then say, let us use dates. First quarter, the first quarter here, the first quarter for the 2025-2026 year, right, was consumed, right, was consumed. First and second quarter were consumed before we arrive at 1 July 2025. Why? Because I mean the first quarter which started from 1 April and ended on 30 June. So the first quarter was consumed. The first quarter ended 30 June, right? This one, 30 June. All right. So the first quarter ended 30 June. That is April, May, June. All right. but we were not yet letting out the property. All right. But we then started letting the property on the 1st of July. So that's when we received our first. All right. So the income was received in the second quarter of 2025. All right. Which was the first quarter. All right. So that was the second quarter was the first quarter in terms of the rental payments. That's when they received their first quarter. Then in the third, they received the second rental. And then in the fourth, they also received the fourth quarter. Remember, starts from 1 January to 31 March. That's the third quarter of rentals. All right. Then the fourth quarter now of rentals, the fourth quarter of rentals started now on 1 April, 2026 to 30 June. This was the fourth rental or the fourth payment relating to that, £5,000. So if it was paid on the 1st of April, it simply means that it falls within the tax year, because the tax year is ending on the 5th of April. But these rentals are paid. Okay, the rentals are paid in advance. So they were paid on the 1st of April, which means they are part of the business income, the property income of 5,000. So the 5,000 as it is going to be taxed in the year 2025, 2026, in the tax year 2025, 2026, despite the fact that much of the usage of this fourth quarter was now relating to the rental enjoyment for the tax year 2026, 2027. But because it is the cash basis, we are going to use, to tax that money that has been received, despite the fact that the period to which it is going to relate is going to be a future period. But because we have received it within the tax year, we have 2025, 2026, we are going to tax it. Am I being heard? Good. So we're going to tax the full 5,000 there. That was the trick. Please replay this part. Replay this part. Don't mind the grammar. Just replay this part so that you understand why or how we arrived at the taxing of the full £5,000. So now, once you are now certain that the 5,000 is going to be applicable, you then have to come up with something like this one. This should assist us in doing everything. So we have determined that the 5,000 is going to be applicable. So we put our 5,000 here as with the pen now. Okay, so 5,000 is the rental which was received, and then we need to deduct allowable expenses. That is the redecoration of the property. Remember, there was a best pipe, so we needed to redecorate the properties, the repairs and maintenance. So they are going to be allowable. So this one is allowable. What about the repairs relating to note 3? If okay, fine. I think it relates to this £400, which was paid. Remember, Luke paid allowable expenses of £200 in December 2025 related to redecoration following a burst pipe, and £400 in May. Remember, these were paid in May 2026. That is way after the 5th of April 2026. So they were paid, although they are allowable, they are not going to be allowable for our period because we are using the cash basis. So even if they are allowable in general terms, they're not going to constitute part of our return. Why? Because they were paid outside the tax year period. So this is why we are going to put a 0 here. We're not going to deduct them as of now, but later on. So the total allowable expenses are £200. So the property income is going to be 4,800, and that is the amount we are going to then take to the non-savings income computations. Remember the non-savings income computations, please refer to our initial video, which is also available on this YouTube channel. Now, let's talk of something else, guys. Capital expenditure, cash basis. There is no distinction between capital and revenue for plant and machinery. That is the general rule under the cash basis. Allowable deductions, these ones are going to be deducted when paid. So plant and machinery, except cars, are going to be deducted. Maintenance tools are also going to be deducted. Office equipment is going to be deducted. The exceptions now, which ones? Those which are not allowed. The cost of the car itself is not going to be allowable. Residential items, furniture, TV are not allowed. Also not allowable, the capital expenditure on land and buildings. This one is also not allowable. Repairs and maintenance. Repairs are allowable. All right. These ones restore assets to original condition, not exceeding the original condition, but to the original condition. Replace subsidiary parts. If you're going to replace some parts, example, replacing damaged roof tiles is also an allowable expense, but improvements are not allowable, right? Some enhancements to the asset beyond original condition, that's an improvement and it is not going to be allowable. An example, adding another story. Suppose you were having a 2-story building, but you now want to make it a 30-story building. That, a 3-story building. That is not going to be allowable. Right. So repairs is equal to revenue. They are deductible, but improvements are going to be considered capital expenditure, and they are not going to be deductible. Now, what about cars? Because they're also part of property planning equipment. So what are we going to do with cars? Because remember, we said that the cars are not going to be allowable. So there are some options, option 1 and option 2. If you are given cars in the examination, the first route you can take is to use the capital allowances plus the actual cost. That is the fuel, the insurance, and so forth. So there will be some allowances that are going to be given with regards to cars, some with regards to the CO2 emissions and so forth. All right, and then the second option is going to be the mileage method. All right, so if you are using the mileage method, you need to know that for the first 10,000 miles, you are entitled to 45 pence per mile, all right, as a deduction, 45 pence per mile up to 10,000 miles. Then over 10,000 miles, you are going to be allowed to deduct 25 pence per mile. These replace capital allowances and actual cost. So the moment you are using the mileage method, you are not going to then use again the capital allowances method. Why? Because you would then be doing what is called double dipping, which is not allowed by the taxman. What about replacement of domestic items? The replacement domestic items relief. This one applies to residential lands. Okay, residential lights, furniture, TVs, carpets. Um, you are going to enjoy what is called replacement domestic items relief. The rule here is that no relief for initial purchase, relief is only for the replacement. Remember, we say that these items are not deductible in our initial session. So, what is going to be deductible is their replacement. So, the moment you purchase a TV, do not treat that cost as a deductible. No, but the taxman wants you to be in trade first. And then, after you entered into trade for after some years or after some months, you then need to replace the old TV. That's when you are going to be allowed to enjoy the RDIR. So the computation, the deduction there is going to be the cost of the replacement less any proceeds from the old item. The improvement limit. If you upgrade, for example, fridge to fridge freezer, you only deduct the cost of a standard replacement. Please note, fixtures, for example, boilers, radiators, are treated as repairs to the building, not RDIR. They are not available. This RDIR is not available if rent a room relief is also claimed. So if you are claiming the rent a room relief, you are not going to claim any RDIR. Now, let's look at this example. It's a bit complex, but we just have to be comfortable with it because that's exam standard. Kate owns a cottage that she lets out furnished at an annual rent of £3,600, payable monthly in advance. She incurred the following expenditure. So, replacement of bedroom curtains, £150. Replacement of one broken kitchen unit in a fitted kitchen with a similar, with a unit of similar standard, £275. Insurance for the year from 5 July. The previous year amount was 420, but this year was 480. And November 2025, there was a dishwasher, which was £380. And May 2026, some redecoration work completed in March, but obviously was paid in May 2026. That's £750. The tenant had vacated the property during June 2025 without having paid the rent due for June. Kathy was unable to trace the defaulting tenant but managed to let the property to new tenants from 1 July 2025. The new tenants paid a security deposit of £800 on Kathy on 1 July 2025. The old bedroom curtains had no disposal value. A dishwasher had not previously been provided in the property. Kathy drove 120 miles in her car in relation to the property business during the tax year 2025-2026. She claims HMRC's approved mileage allowances. Calculate the property income for the tax year 2025-2026. Okay, now the first thing we need to establish or we need to always remember is that if the examiner doesn't tell us which method Kathy was using to account for the property income or which basis, the default basis is the cash basis. All right, that's the default basis. Also, you can lead yourself to be confident that it is the cash basis that is at play because the rental income itself is less than £150,000. So obviously, that's the cash basis at play. All right. Now, we are told that the tenant had vacated the property during June 2025 without having paid the rent due for June. So Kathy was unable to trace the defaulting tenant, but managed to let the property on new tenants, to new tenants from 1 July 2025. All right. So if she didn't receive, you see, if she didn't receive her money for 1 month, what it simply means is that the amount, because this 3,600 is an annual amount. All right, but there was one time she didn't receive the money. There was 1 month she didn't receive the rental. So in that case, we are going to deduct the rental related to that month. So how much is that? How much is going to be the rental income? That should be the rental income should be, ladies and gentlemen, what's going on? Okay, the rental income should be 11 over 12 multiplied by 3,600, right? That should give us something a little bit lesser. Okay, so that's for the income part of it. All right, nobody is going to tell you that. You see, when we are using the cash basis, as long as the amount is paid within the tax year, right, you just have to only worry on whether of that amount there was a certain month or there were certain month which the rent was was not paid for or was not received for. So in that case, you then have to deduct the rentals related to those months. Otherwise, everything has to be taxed, which was received. But in this case, we were told that there was 1 month this person did not receive. Also take note that the examiner did not say in the statement that she was actually paid £3,600. He only said that 3,600 was the annual rental. Okay, was the general or the ordinary annual rental. All right, but they specifically told us that there was a month where the rent was not received. There was a month when the rent was not received. So we need to take note of that. Now let's come to the allowable deductions. Replacement of bedroom curtains, 150. Yes, the replacement is going to attract the replacement relief. That one, replacement domestic items relief. So this relief is going to be reduced if the curtains had a disposable value or disposal value. If they were having a disposal value, then we were going to reduce the relief by those proceeds. But in this case, there were no proceeds which there were no disposal value for the proceeds. So the full 150 is going to be deductible. Then replacement of one broken kitchen unit in a fitted kitchen with a unit of similar standard. So if you are replacing with a unit of similar standard, it simply means that the full expenditure is going to be allowable. All right, less of course with less any proceeds received on disposal, but we were not told that thing. So the full 275 is going to be deducted. Then what about insurance for the year from 5 July to the rest of the year? Remember, this is a cash basis. So the moment we made a payment, regardless of the fact that the payment was also relating to the other period, upcoming period, that one is not going to hinder us from deducting this 480. All right. This one here was just, something to throw you overboard, because it doesn't matter whether the insurance has increased in value or not. All right. So the actual payment is the amount that is applicable here. That is 480. November, there was a dishwasher purchase. So we were told here that the dishwasher had not been previously provided in the property. So this one was a new purchase. This one was a new. So being a new purchase, we are not going to deduct it. Okay. So this one is not allowable. That's not an allowable expense. And we are not going to claim any capital allowance, because these are residential items. They are used in residential property. So no AIA on them. Do not. No AIA. Okay, there's no AIA, annual investment allowance. No annual investment allowance is going to be applicable there. What about or the financial year allowance? It's not going to, first year allowance, no, none is going to be applicable. No allowance is going to be enjoyed on the dishwasher, because it is a residential item. May 2026, there was redecoration work which was done, but the work was completed in March 26. But the redecoration itself, the payment was made in May. So if the payment was made in May, it's May 2026. That was outside our tax year. So even if the work was completed within the tax year, but the payment was done outside the tax year, that means that the 750 is going to be taxed in 2026, 2027 tax year, not now. So for the purpose of our computation, we are going to ignore it. So, ladies and gentlemen, this is the simple presentation I would expect you to come up with. So the property income for 2025, 2026, we are going to have the rental received of 3,600, which was the annual rental expected, okay, multiplied by the fraction, the adjusting fraction here, the months, the prorating fraction, okay, because only 11 months was received. Only rental for 11 months was received. So this comes to 3,300. Then the expenses, remember the curtains, the full amount of 150, the kitchen replacement 275. Then insurance, the full 480. The dishwasher, this one is a capital expense. So we are going to put a zero. Do not ignore making an entry whether it was a zero. Just because it was a zero, you need to indicate to the examiner that you understand that there was a zero required. Okay, because if you simply do not write anything, then by the end of the day you're not going to earn any mark. So you need to show the examiners that I am very, very knowledgeable of the fact. Then redecoration. Remember, this one was done outside. The payment was made outside the tax year, so we are going to put a zero there. The mileage allowance. This lady traveled how many miles? According to the question, she traveled 120 miles relating to the property business. So every expenditure that is related to the business is going to be allowable. But because these are mileages, we are entitled to 45 pence for the first 10,000 miles. So she traveled only 120 miles, so multiplied by 45 pence, and this comes to 54, which is deductible. And we sum them up, these expenses, and we arrive at 959, and we deduct this amount from the 3,300 on top there, and we are going to arrive at property income of 2,341. This is then taken right? If you are asked to compute the tax liability for this individual, you then have to slot this one under the non-savings income. In our computation table, remember the computation table, please refer to our first video. Otherwise, if you do not go back to that video, all these are going to be cloudy. It's going to be confusing. All right, good. Now let's talk of the restriction on residential finance costs, the 20% restriction. Now, this is the rule. Finance costs, that is interest or bank fees, for residential properties are not deductible from property income. So what then happens? The mechanism. You need to calculate property income with zero interest expense. You then have to calculate income tax liability and then deduct a 20% tax credit at the very end. That's what you are allowed to do. So the formula, the interest paid multiplied by the 20%, this comes to the tax credit which we are talking about. All right, so for non-residential properties, interest on offices or warehouses remains fully deductible from income. So for those other properties which are not residential in nature are then going to be their interest is going to be tax deductible, right? You are going to, you're going to deduct it fully from the income. Now, let's look at this example to see what goes on. Okay, Ryan owns a residential property that he lets out. During the tax year 2025, 2026, he received rent of £15,000. So he actually received this money and paid the following expenses. So we are given the agent's fees, £1,000, insurance paid out, 1,500, gardener's cost, 1,300, interest cost on loan to acquire property, 7,500. During the tax year 2025-2026, Rent also has trading income of 42,000 and bank interest income of 8,000. £800. Calculate Ryan's income tax liability after relief for the tax year 2025-2026. So here we are given three incomes. And that's when that table becomes essential. The first income we are told of is the property income. Then we are told of the trading income, as well as the investment income, savings income or bank income. Now, because there was some interest income there. So these first two, the property income and trading income, these ones, they constitute what is called non-savings. Hey, what's going on, man? What's going on? Everything which I've written is gone. I'm sorry. Okay. Man. All right. Let me just try to replicate what I have already said. I said that we are having three incomes. All right. The first one is property income, then trading income, and then bank income. The bank income, and I said that these first two constitute non-savings income. and the other one is savings income. The bank interest income is savings income. This classification is very important because these incomes have got, different rules that apply to them. All right. Now, once you have determined the income side and you're comfortable with it, the general outlay, you then have to ask yourself on the expenses side, which expenses are deductible, especially when you are computing your property income, because it needs to be identified. Remember, if we say that the non-service income constitutes of trading and property income, we are simply saying that that trading income has to be adjusted to some extent. That property income has to also be adjusted or computed to some extent so that you come up with the rightful figure you are going to slot in your table. So let's start with the property income computation, because that's very, very important. For the property income, ladies and gentlemen, we have got our rent received, which was £15,000. That was the rent received less allowable deductions. Allowable deductions, we have got the agent's fee, the agents, that is 1,000. Insurance, that's 1,500. Okay, ma'am. Uh, the gardener's cost, I'm sorry for the disturbance. The gardener's cost, the gardener, obviously these ones, they are required. The guys who do the landscaping, etc., to ensure that the property is inhabitable and is also having those aesthetics which are important to attract tenants. So the gardener's costs are deductible, 1,300. What about the interest cost on loan to acquire property? This one, because this one is a residential property, this one is not going to be allowable. So you put it here as interest, then you put a zero. Remember, this one is a working for property income, right? It's a working. So you put a zero. It's a zero, ladies and gentlemen. All right. And then you compute, you get the total expenses. How much are they? That's 1.5, 1,000 plus 1.5, that's 2.5 plus 1.3, that's 3.8. 3,800. These are our total expenses. Then we deduct them from the income there of 15,000 pounds. How much property income are we going to be left with? The property income there, I do not have my calculator here. Let me look for the phone. Oh yes, I'm sorry for the delay. We are saying that 15,000 minus 3.8, that's 11,200. Ladies and gentlemen, that's the property income. That's not the income tax liability. That's the working for property income. Now we now have the three figures. Okay, we now have the three figures. A lot of people make a mistake and put this figure as the income. No, that's not the income. That was the rent received. Okay, the actual income that is going to be taxed, the taxable income from property business, is this. This is the amount that is going to be taxable. That is taxable. Okay, or that is going to be considered as income for tax purposes. All right. So we have got now the three figures: the trading income for 2,000, the bank income, the bank interest income 800, and the property income. Let us now have a table. Okay, so the table is going to assist us to be very, very organized. So non-savings, we have got the savings. If there were dividends, then we're going to have another column for dividend income, but this time there's no dividend, so we just have to work with what we have. So this table, ladies and gentlemen, is very, very important in our exam. So you come here and say trading income. I normally start with trading or salary, okay, or income from employment. So that's trading income. How much was it from the question? £42,000 for 2000. And then we've got property income, that is our working one. You need to tell the examiner that I have done the working. I've done the working. If the working was wrong, you're not going to be penalized twice. You simply have to pick that figure from your workings, that same figure from your workings, to show that you are organized. All right, so we determined how much, 11,200. Okay, and another income, the third income was bank interest. Bank interest, and this was given in the question is £800. Let me verify. Good. That's £800. So we then have to total. Let us give some total. You need also to transfer all these figures to this outer column, 200 and the 800. So if we add up here, let me just use my calculator. For 2000 plus 11,200, that's 53,200. Okay, 800. Then here, what is the total there? That's 42,000 plus 11,200 plus 800. That comes to 54,000. So this is the total income we have. But now, after you reach this one, this total income row, you then have to ask yourself, how much are we having in this column? We're having 54,000. So 54,000 is within which tax band, or is within which taxpayer category. If the person is having income of 54,000, obviously this guy is no. Before that, you first of all have to determine. All right, so this figure here in the total income is actually going to assist us to determine if this person is entitled to what is called the personal allowance. That's the purpose of this figure. If a person is having income of 100,000 or less, they are entitled to a personal allowance every year. So that personal allowance is 12,750 pounds. So, all right. So that's 12,000. Okay. Let me just. It's actually 12,570. But you can verify from the text tables. Just but I'm scared now that if I try to make some unnecessary movements here, I'm going to disturb my computations there. But I'm sure I'm going to be, we need to verify. So it's 12,000. It's actually 12,570. That's the personal allowance I am talking about. Okay, so let us get back to our page. 12,570. I'm sorry to have, given you the wrong one. Okay, now we then have to deduct this amount. So that's 53,200 now minus 12,570. This gives us 40,630. 40,630. Okay, so this becomes our taxable income. So make sure everything is going to come to the outer column. Okay, and that's 800. So let us get the total there. That's 40,630 plus 800. That gives us 41,430. You can as well cross check to see if that is the same story. If we say 54,000 minus 12,570, are we going to arrive at that point? Now, when you arrive at this figure, you then have to ask yourself, is this taxpayer a basic rate taxpayer, a high rate, or an additional rate taxpayer? This one is a high rate taxpayer. Why? Because his income is above the basic rate, which is between 0 to 37,770 pounds. So the first income is going to be taxed at the basic rate of 20%. That is the first 37,770. It's going to be taxed at the basic rate of 20%, and the additional or the remainder is going to be taxed at the high rate of 40%. Remember, we are still using the information from the tax tables. Okay, this is what we are talking about. The basic rate is that income between £1 to 37,700. Oh, not 770. Oh my God, I'm sorry for that. It's a dollar. A pound up to 37,700. Okay, we tax that one at 20%. Then an income between 37,701 and 125,140 is taxed at 40%. And then an income above, okay, and then an income above 125,140 is going to be taxed at 45%. That's the additional rate taxpayer category. Now, let's get back to our computation. Okay, I'm sorry, my face is disturbing here. Okay, so I'd forgot something to underline here. Just have to close. Okay, so you then have to do the income tax computation now. Oh, my space. Let me try to increase another page here for the workings. Okay, now, so we can safely move to the income tax computation. Guys, what am I doing? Income tax computation. The income tax computation is going to be systematic. So we are going to follow our table. The sequence as determined by our table. Okay, our table starts with the non-savings, then the savings as we proceed. So let's first of all apply the tax on the non-savings income of 40,630. But we can see that this 40,000 is both relating to the basic rate as well as the higher rate tax band. So we then have to come here and say non-savings income basic rate. Okay, so the basic rate is applied on the 37,700 multiplied by 20%, and this should give us 37,700 multiplied by 20%. That's 7,540. Remember, these are pounds. Then we come to remember, the total of the basic rate, the total of the non-savings, actually, the total of the non-savings was 40,000. This is the amount we are talking about, 40,630. So everything you are going to do is should add up to that amount. So what is the balance, the outstanding amount there? That's 40,630 minus 37,700. This should come to 2930. 2930. And this is the amount that is going to be taxed at the higher rate of 40%. So you come here and say non-savings income, higher rate. And you then say 2930 multiplied by 40%. That comes to 1172. Okay, so you are done with the non-savings income. You come to the savings income. Savings income. Now, for savings income, we are also aware that there is what is called the new rate. The savings income new rate. Savings income new rate, according to our tables, the savings income new rate band is 1,000 for basic rate taxpayers, but for higher rate taxpayers, it is 500 pounds. Is this guy a basic rate or a higher rate taxpayer? We have determined that he is a higher rate taxpayer. So in that case, he is entitled to the 500 pounds. The first 500 pounds is not going to be taxed. So that's the new rate is going to be the new rate is going to be 500 at 0%. That is going to be a 0 here. Then the savings income higher rate is going to be the remainder here. That is the 300. Remember, this guy's savings income was 800. Remember that. Okay? So this 300 is going to be multiplied by this guy's tax rate threshold. That is the 40%. But why? Because he is a higher rate taxpayer. Do not use the 20% there. Okay, so 300 multiplied by 40%, that comes to 120. You can then cross-check to see if you have included all the figures by adding this amount and that amount. They should come to the total. The total, that is the total, which was 41,430. If they don't do so, you would have made some error somewhere. Okay, let me just cross check. 4,630 plus 800. Obviously, 6 plus 8, that's a 14. So that's 41, 430. Isn't it the figure yes, that's the figure we are talking about. Good. So you then have to add up these figures. 7,540, 1,172, 0, 120. Adding this up, they should give us something like, let me just do the computation here. That's 8,832. 8,832. All right. Then we then have to include what then is called the tax relief. Tax relief. That is, or tax credit on bank loan, bank interest. Remember, when we were computing bank interest on property income, on property business or property income loan, remember, this guy took a loan, and we said that loan when we were computing the property income, we said that this guy was not entitled to the deduction. We put a zero, remember here, there was a zero. But the tax rules give this person some tax credit on the interest. So there should be some tax credit on the interest. And this tax relief is just the basic rate, is the 20%. There should be the 20% on the interest itself. So we come here. How much interest did he pay? He paid 7,500 bank interest to acquire on the loan to acquire the property. So that is going to be 7,500 multiplied by 20%. 7,500 multiplied by 20%. That is going to be 1,500. So 8,832 minus 1,500. This should give us 7332. 7332. And ladies and gentlemen, this is our income tax liability. Income tax liability. It was quite a long journey, but very worth it. Yeah, worth it. Yeah, it was something that was essential for us to take. I'm sure we have been given all the essential information required. We can as well attempt this example. MSET acquired 2 residential properties on 1 June 2025 that were first let on 1 July 2025. Okay, property A is let unfurnished for an annual rent of £4,000 payable quarterly in advance. MZ incurred the following expenditure in respect of this property: repairs to the roof following a storm on 15 June, £1,600. Interest on loan to acquire property for £120. Repainting exterior, £845. Property B is let furnished this time. Is let furnished for an annual rent of £5,000 payable quarterly in arrears. The tenants were let in paying the amount. They were let in paying the amount due on 31st March 2026. This was not received until 15 April 2026. MZ incurred the following expenditure in respect of this property in the tax year 2025-2026. Letting expenses paid to agents, £40. Insurance for the year ended 1st March 2025, £585. Cost of furniture, £2,000. Cost of soft finishing, £500. Calculate MZ's property income for the tax year 2025-2026. Okay, guys, in the examination, there won't be much time. This type of question can be given in section A, multiple choice. So you need to pay very careful attention to detail. So you are required to only to compute the property income. And if you still remember, the property income is that working only, this part of the working, this on working only. not the production of this other, this table. You are only required in our question to compute this figure alone, that figure alone. Okay, so don't then go extra mile. I thought it was very, very important to highlight that one. Okay, so let us remember both these properties, property A and B, are going to be considered one business by the end of the day. So you need to determine the property income for property A, property income for property B, then you sum them up, you come with one property income figure. One property income figure. All right, so let's start with property A. Property A is an annual rent of £40,000. So this one is paid in advance. So if it is paid in advance, so obviously that amount was received, unless we are told that there was a month where the tenant did not pay this and that, but we are not given those facts. So we assume that rent was received. So this is property A. Property A, rent received. How much? 40,000. £4,000. That one was received. Then less expenses allowable. Not any expense, but those expenses which are allowable. And what are they? Repairs to roof following a storm. If there was a repair to the roof following a storm on 15 June, but this guy started trading on they were first let on 1 July 2025, but there was a pre-letting expense of 1,600. That one is allowable. So 1,600 is allowable. You deduct that one. Interest on loan to acquire property. This one is not allowable. So interest on loan to acquire residential property is not allowable. So that's a 0. Repainting the exterior. If we are repainting the exterior, is that cost allowable? Repainting is a way of restoring the original state of the building, the original status or state or condition. So repainting is allowable. Repainting, how much? 845. So what is the PI, the property income? The property income there, that's, let me use my calculator. 4,000 minus 1.6 minus 845. That comes to 1555. 1555. Okay, please, this is a 1. Don't mind my handwriting is poor. And when I try to adjust the 1, there's usually going to be some problem. Okay, that's 1555. Then let's do for property B. Let's do for property B. Rent received. This one is paid quarterly in arrears. Okay, they get annual rental of 5,000 payable in arrears. The tenants were let. You see the the description or the statement of the examiner. They are saying the tenants were let in paying the amount due on 31 March 2026. All right, this was not received until 15 April 2026. All right, so this information alone, if the amount due on 31 March, remember 31 March is the end of another quarter. All right, so the amount due on 31 March 2026 was not paid until 15 April 2026. However, these guys started staying. Okay, they started staying at this property on 1 July 2025. That's when they started staying at this property. So the first quarter which they had to pay was which quarter? Was the quarter ending, let's say July, August, September. By by 3rd September, on 3rd September, the first quarter was ending. Then the second quarter, that's October, November, December. That's the second quarter, and the third quarter now, the third quarter, which is the quarter ending 31st March, right? This quarter was not paid for. So the quarters which were only paid for were only 2 quarters. 2 quarters were paid for. Have you seen that? The first quarter, which was ending on 3rd September, was paid for on the 3rd of September. Why? Because they pay in arrears. Then the other quarter was paid for on 31 December. Then the other quarter, which is now in 2026, was ending on 31st March 2026. But this one was not paid for until 15 April. So if it was paid until 15 April, it was paid on 15 April, it simply means that that payment on the 15th of April cannot be accounted for in our tax year, the 2025-2026 tax year. All right, because this is a cash basis. We are still on cash basis. So far, we are still on the cash basis. Please bear that in mind. So the rentals here, which we are going to account for, are 5,000 multiplied by 2 over 4. Why am I saying 2 over 4? Because we have got 4 quarters in the year, but only 2 were paid for. So that's the idea. So what do we get there? That's 2,500 as the rental which was received. Then we have to deduct the allowable expenses. Less allowable expenses. The allowable expenses, let's start with the letting expenses paid to the agent. This one is allowable. So agent fees, 40. Insurance for the year ended 31st May 2025, 585. So insurance is allowable. The cost of furniture and the cost of soft furnishings, these are capital in nature. These are capital, so they're not allowed. This one again is capital, not allowed. And because they are relating to residential property, no capital allowances, those AIAs, are going to be available. So we don't have to, you see, you may say furniture, soft furniture, put zeros, and you come to your PI, your property income. So that's 2.5 minus 40 minus 585. That gives us 1875. 1875. Now, with 1875 added to 1555 there, you come to your consolidated PI. That's 1555 plus 1875. This should give us 3430 as the property income figure which we need. Seems like we were having it right. Yeah, we were having it right. This is answer. Okay, let's proceed to the next segment, the accruals basis. So when is this accrual basis used? It is used when when optional. It is optional for individuals or partnerships. They may choose to use it if they find it fit, but it is mandatory if income of the property owner, the property business income is greater than £150,000. You are mandated to utilize the accrual basis. In the exam, use only if specified. You need to use the accrual basis if it is specified or if the income is £150,000. Um, the recognition principle. Income and expenses are recognized on an accrual basis. Rent receivable and rent payable for the year are going to be recognized. So if you are recognizing income and expenses on an accrual basis, we are simply saying that even if you didn't receive the actual money, but the fact that you were entitled to the money, it means that you have earned that money. Also, on the expenses side, even if you did not actually pay for those expenses, but you have in essence incurred them, then you are allowed to deduct them. Bad debts or impairment losses. Unpaid rent is taxed. Even if the guys are not going to pay you, you're going to be taxed. Then deducted as an expense, which is an impairment loss. You need then, if they have become irrecoverable, you are allowed to deduct them. This is unlike the cash basis where it is never taxed. Expenditure and allowances accrual basis. Plant and machinery. This one is not deductible. You are allowed to claim allowances instead. Land and buildings generally not allowable. Possible structures and buildings allowance for non-residential buildings, but not land. The SBA to be discussed later. Other rules, same as cash basis. Replacement domestic items relief is going to be applied. Finance cost restrictions for residential property is also applicable in this situation. Let us look at this wonderful example. Sharpen owns a property that was let for the first time on 1 July 2025. The rent of £5,000 per annum is paid quarterly in advance. Sharpen paid allowable expenses of £200 in December 2025 related to the redecoration following a burst pipe in November 2025 and £400 in May 2026 related to repair work which was completed in March 2026. Calculate Sharpen's property income. Assuming they have elected to use the accruals basis for the tax year 2025-2026. So this one should be done in just 1 minute. So let's start with the render received. Remember, this is the accrual basis. We are in the accrual. Okay, so rent received. We are told in the question that the property was let for the first time on 1 July 2025. So from 1 July to the end of the tax year, the end of the tax year is 6 April. So we are having 3 quarters here, okay, up to 31 March. That's the end of the third quarter. Third quarter is ending 31 March. All right. But now this income is being received on in advance, which means on 1 April, the start of another quarter is going to be rent which was received. But we are using the accrual basis. The accrual basis, it means that you need to match the income with the relevant period to which it relates. All right. So income which is paid on the 1st of April is not relating to the current tax period, but it is relating to the tax period of 2026-2027. It is not related to the tax period. That's the accrual basis. All right. The other way of looking at it is that that income is for the period, is for the quarter. All right. The relevant quarter it relates is from 1st April ending 30 June. So it is not part of our period for tax purposes. All right. So the relevant periods, the relevant period is from 1 July to 31st March. That is 9 months. So the rent received is going to be 9 months over 12 multiplied by the £5,000. Let me use this calculator of mine. That gives me 3750. Now, once I get the rent received, the allowances, the deductions are not going to be problematic. Allowable expenses. Okay, Chatting paid allowable expenses of 200 related to redecoration. Redeco. My pen is no longer visible there. Let me try to use the black pen. Hope it is the redecoration. Sorry, the redecoration. How much was it? The expense was 200. It's good practice to put the expenses in their own column. Then the 400 related to work which was completed in repairs or repair work, that's 400 which was paid in May, but it related to repair work which was completed in March. So the work was completed in March, which is within our tax year. So because this is an accrual basis, the expense itself was applicable, was relating, was incurred within the tax year. So in that case, the expense is going to be considered as applicable, as allowable for this tax year. So that's, we're going to put the 400 here. We add them up, we get 600. We deduct this 600 from the 3,750. We are left with 3150. This is our property income. Okay. The structures and buildings allowance. This can be claimed on new non-residential buildings or structures, renovations or extensions or improvements to existing buildings, available to property businesses using accruals, relief given as 3% straight line allowance per year. It starts when the asset is brought into use. It is time apportioned in the first year. The exam technique. Second-hand or existing buildings. Question will state if the structures and buildings allowance is available. New construction or renovation. Question may not mention SBA. You must identify eligibility yourself. So for new constructions or renovations, please. And so for you to identify the eligibility, please utilize this first part. I mean, this information. Restriction not available if using cash basis for trading income. So if you are using the cash basis, do not worry about the structures and business allowance. Do not consider them. Structures and business allowance continued. Qualifying expenditure in general, that is not limited to property income. So in general, we are saying that the buildings, the offices, retail and wholesale premises, factories and warehouses, subsequent improvements, all these qualify. And when we're talking of structures, like for example, roads, walls, bridges, tunnels, all these qualify for the SBA. Non-qualifying expenditure in general, expenditure on land, legal fees, repairs and maintenance, these ones are not going to qualify for SBA. SBA key rules. No pooling system. Each asset is treated separately. You do not have to bunch them. So each asset is treated separately, not included with capital allowance pools. So once you use the SBA, then you cannot use the capital allowance pool system. No AI available. Assets qualifying for SBA cannot claim AIA. No balancing allowance, unlike capital allowances on disposal of the asset. The chargeable gains treatment SBA claimed is added to sale proceeds. So when you dispose of the asset on which you claimed SBA, you then have to include that SBA which was once claimed to the sales proceeds, and you then have to arrive at the chargeable gains. So which means that the taxman would want to plow back those capital allowances which they had given you. The buyer treatment, buyer continues claiming the remaining SBA. So if they sell you an asset, they will still continue to claim the remaining SBA on the allowance, on the asset. Okay, remember SBA is 3% of the asset's cost. All right, so which means in essence, this asset is going to be, this SBA is going to be claimed for about 33 and a third years. So until the expiry of these years, the buyer is going to continue claiming the 3% on cost. Because remember, it is claimed on a straight line basis. Allowances are apportioned in year of sale. Now let us look at this example where there is an SBA aspect to be considered. Tawanda runs a property letting business accrual basis. Remember, SBAs are only going to be applicable in property income when the accrual basis is being used. Tawanda runs a property business, a property letting business using the accrual basis. For the year ended 5 April 2026, he let out a commercial warehouse to a tenant. The rental income receivable was 120,000. insurance, £5,000, repairs, £8,000, loan interest, £10,000. So these are the expenses. On 1 July 2025, Tawanda constructed the warehouse for letting at a cost of £200,000. The warehouse was immediately let to a tenant. Calculate his property income. So let us calculate Tawanda's property income. Okay, so this is a commercial property. It's not. It's a non-residential property. Okay, it's a commercial warehouse. Remember. So certain rules, especially those regarding the loan interest, are going to differ from those when we do residential property. So we start with the rent received or rent receivable. Rent receivable, that is 120. Let me just what type of pen should I use? I hope you guys are seeing it. I'll show you the answer anyway. That's 120,000. Then less allowable expenses. Allowable expenses. Insurance, is it allowable? Yes. Insurance, that's £5,000. So this one should also be a column. And repairs, 8,000, they're allowable. Loan interest, because this one is commercial property, is fully allowable. And this comes to 23,000. Okay. And we get how much? Let me use this calculator of mine. That's 120 minus 23,000. That comes to 97,000. And then we deduct less SBA. The SBA on the new building. This new building here. We constructed the warehouse for letting at a cost of 200,000. So that's 3% of 200,000. Okay, 3% of 200,000. But when did we construct it? We constructed it on 1 July. So 1 July to 31 March. That's 9 months. So multiplied by 9/12. We need to prorate in the first year. So that's 3%. Multiplied by 200,000, multiplied by 9/12. That's 4,500. This is an allowance, so we reduce. So we get our resultant taxable property income, the property income to be transferred to the non-savings income for tax purposes. That's 97,000 minus 4,500. That comes to 92,500. We are done. This is what we have been doing. Now, there often is a problem with furnished holiday lettings where people were, bombarding my inbox, asking how we are going to treat furnished holiday lettings. Oh, my people, that was before 6 April 2025. These FHLs enjoyed special tax advantages before 6 April 2025. There were no finance cost restrictions. But from 6 April 2025. From 6 April 2025, the FHL regime has been abolished. No more. It is no more. They are now being treated as normal property letting. So they will be treated as normal residential properties. Okay? Or normal property letting. That is, if it is a commercial property that is now furnished and so forth, you just have to treat it the way you are going to treat the commercial property, as we just did. Or if it is a residential property, simply treat it the way you treat interest cost on residential property. So finance cost restriction now applies. So as in the case of the residential property, loss of all special tax benefits. So all those special benefits which were attributable to an FHL have now been lost. So what it means is you just have to treat these as residential properties. Yeah, in essence, because if we are saying finance cost restrictions now apply, financial cost restrictions are applicable in residential properties, not in commercial. So treat them as residential property. Using the normal way of residential property tax accounting. Now, what about lease premiums? Lease premiums, short term leases. A premium here is the lump sum for a lease which is less than 50 years. So the property income element is the assessable amount which is equal to the premium. When you are given a lump sum by your tenant, you are going to account for some assessable amount on that premium. And remember, we say the premium is a lump sum payment the tenant is going to give you for their stay at your property. And the assessable amount for tax purposes is going to be that premium minus, in bracket, premium, that premium multiplied by 2% multiplied by n minus 1, where n is the number of complete years. Okay, the number of years the tenant is going to be on your property. So the simplified formula is the premium multiplied by 51 minus n divided by 50. Okay, you just have to memorize either of the two formulae. All right, either you use this one, okay, which is a bit long, or this simplified one. All right, the 51 minus n formula there. So you are a landlord and you are given £26,000 for 18 years. Okay, the assessable should be 17,160. Why? Because if we try to put this in the formula there, that is 26,000 multiplied by 51 minus 18 over 50. Over 50, this should be giving us that same amount. Okay, let me try to use this calculator of mine. 51 minus 18, that's 33. Okay, 33 over 50, that's 66%. 66% multiplied by 26,000, that's 17,160. This is the amount that is going to be property income. That's property income for tax purposes, which should be transferred to the non-savings income. column. Now, let's talk of the rent a room relief. When a furnished room in an individual's main residence is let, a special exemption applies. So in the UK, they try to, uh, encourage their people to have some side hustle. So you can have a side hustle through letting one of your rooms to the public, to tenants. So when you do so, you are entitled to a special exemption. There is a special exemption, which means a certain amount of money you are going to get is not going to be taxed. As for other property income, the cash basis is the default basis and should be used in the examination unless specifically stated to the quadra. Okay. The threshold is £7,500 per year. Okay, but if it is shared, if the property is shared, then you need to divide by 2. Suppose you are having a partner and you are jointly owning the property, so you then have to share this exemption. You need to share. Scenario A. So in this scenario, the receipts are less than 7,500. So if you are entitled to render income that is less than 7,500, automatically that render or that income is tax exempt. No fuss there. The render is tax exempt. Scenario B. If the receipts you are going to get from that room you are letting out is 7,500, is greater than 7,500, then you need to choose the lower of total rent minus actual expenses. So if the total rent minus actual expenses is lower than 7,500, if the total rent minus actual expense is lower than total rent minus 7,500, then you need to choose that which is lower. So it is the lower of these two. The lower of these two. The lower of the two. Okay? Given that the receipts you are going to receive are greater than 7,500. All right? That's when you have to pick the lower of the normal method, that is the total rent minus actual expenses, and the relief method, that is total rent minus 7,500. Whichever figure is lower is what you are going to choose. Okay. The election must be made by 31 January following the second anniversary of the tax year. So you need to make the election of which method you are likely to use. Let's look at this example. Okay, so if in an exam a student sees a question where rent is £9,000 and expenses are something like £1,000, what they have to do is to automatically use the second option. Remember, we're given two methods. We're given two scenarios, where the first scenario was where the receipts are less than 7,500. If the receipts are less than 7,500, it simply means that those receipts are not going to be taxed. Why? Because they are below the tax exemption, which is £7,500. But if the receipts are greater than 7,500, in this case £9,000, it simply means that we then have to pick a method that is going to give us a lower taxable profit. Remember, a higher taxable profit simply means that we're going to pay more tax. So in this case, we're going to choose that option that gives us the lesser taxable profit. So in this case, we need to do both calculations using method one, the normal way of doing things, where we are using the income regressed against the expenses. That's 9,000, which was the rental income, minus the expenses, and we are left with 8,000 pounds taxable. Or we choose for the allowance methods, or the relief method, where we are going to say the rent of 9,000 less the tax exemption of 7.5, and we are left with 1,500 as taxable profit. So obviously method 2 in this case is going to be applicable. But sometimes you might be given a rental of say 200,000, and the expenses might be, let's say, 190, or let me just say 180 minus 180,000, using option 1. Okay, the option 1 would mean that the taxable profit would be 20,000. But what about option 2? Option 2 is going to say 200,000 minus 7,500. So in this case, we are going to be taxed on 192,500. So in this case, you can see that option number 2, where we use the relief method, is not going to be making sense. All right, so you need to do all the both workings. Always calculate both and pick the one that results in the lower taxable profit. Because if you simply always tell your mind that I'm just going to go for the allowance method, where we are going to use the exemption of 7,500, you might end up paying more tax. So decide early. Decide in an informed way. Now, let's talk about property business losses. In-year losses, that is, losses from property A automatically offset profits from property B. Remember, in the eyes of the taxman, these various properties, they belong to one business, one single business. So a loss in property A might, or is going to offset the profits in property B. All right? The overall loss cannot be offset against trading or employment income. All right, so the overall loss is not going to offset. It's not going to offset other incomes which are not property incomes. All right. So the future, carry forward. You need to carry forward indefinitely to offset against the first available property profits. So property profits are offset by profit losses, nothing else. A result, property income is treated as 0 pounds in the year of the loss. So where you incurred a loss, do not take that loss to that table, the non-savings table. No, it's not allowed by the taxman. All right, what you simply do is to just put a 0 on property income. Just say property income 0. Don't put the negative figure there. All right, let us pause the video and do example Rhoda. Okay, now Rhoda owns 3 properties that were rented out. Her assessable income and allowable expenses for the 2 years to April 2026 were property 1, 2, 3. The incomes for the 2024-25 year, that's 1.2, 450, 3.150 pounds. Okay, and the relevant expenses for the 2024-25 year were 1.8, 600, 280. All right, and for the 2026, those are the figures beneath the 2024-2025 year. Now, you are required to calculate Rhoda's property income or loss for the tax years 2024-2025. So let us first compute the profit or loss for the 2025 tax year. So for property 1, that's 1.2 minus the expenses there of 1850. So it simply means that for the 2024 2025 we are having a loss there. How much is that? 1.2 minus 1.850, that's 650 loss. So we are having a negative there, 650, which is a negative. Then in on property 2, we have 450 as income and 600, so there is a loss of 150. Here there is a 3.150 minus 2.8, that's some profit in a way of how much. 3150 minus 2.8, that gives us 350, which is a profit. And do we have on the total here, do we have a profit? Obviously that's 650 minus 150, this comes to 800 minus 350, there is a loss of 450. That's a loss. What about for the year 2025 2026? 2025 2026, guys, let us play around with the figures. For the 2025 2026 income was 800 for property 1, and there was an expenses of 900, so there was a loss of 100 pound loss. And then 1750 minus 950, 1750 minus 950, that gives us 800 loss. There's a loss. No, that one is a profit. Actually, it's not a loss, it's a profit. Do I have an eraser there? That's a profit. Be with me there. That's a profit. What about 2550 and 2700? So here we are having 255 minus 270, so that's a loss of 150. So let us get the total there. That's 100 plus 800, minus 100 plus 800, that's 700, isn't it? Minus 150, that is 550, isn't it? Using this calculator, that's 550, which is a profit. Okay, and this simply means that the amount of tax that the amount of property income this time around for 2025 to 2026, the property income is going to be 100. That's the property income. However, for the year 2025 2026, there was a zero in terms of property income. The property income there, the PI was zero for 2024 2025, but PI for 2025 2026 is now 100. That's how you are going to treat the losses in the year in which the losses are going to be sustained. They want to be earned property income, but in subsequent years, all the profits are going to be offset with the previous year's losses. All right, but remember, these losses are not going to offset other types of income, for example, employment or trading income. They are not allowed. You are not allowed to offset them. Is that clear? Great. Now, let's try this other example. Okay, this one was the solution to that example. All right. Like I said, the property income for this 2024-2025 year is going to be zero. Why? Because there is a loss there. So there is a zero property income. Please, in multiple choice questions, this is the trick. So the property income for that year is zero. It's not the negative 450. No negative property income. All right. Then the loss to be carried forward is that loss. All right. And this loss is going to offset the profit which we would have made. Remember, we found the 550 as the profit, but we then have to less the previous year losses of 450, and the property income to be transferred would be 100. Okay, great. There's no need for you to compute these trading profit or losses for each property as a single entity. Remember, we said we have already agreed that all these properties are going to be treated as one business. Now, attempt this question, and we call property income a day. We call it a day. For many years, Shayla has owned 6 houses in Upland Avenue. That are available for letting. The following details have been provided by the client. That is B1, B3, B5, C8, D4, E7. Rent receivable for the year 5 April 2026. That's 2.8, 1.8, 2.3, 1.3, 1.3, 2.08. Okay, and insurance paid on 1 June, annually in advance to 80, 220, 340, 150, 150, 140. The insurance premiums paid for the year ended 31 March 2025 were 5% lower than the above figures for all properties and were paid on 1 June 2024. Okay, Shayla employs a gardener to look after all the properties and pays him £1,200 a year. There are also accounting charges of 408 a year. Both of these costs are allocated equally to each property. Numbers B3 and D4, B3 and D4 had new tenancies in the year. The cost of advertising for tenants was £50 in respect of number B3 and £100 for number D4. The new tenant at number B3 took over immediately after the old tenant moved out. Unfortunately, the old tenant at D4 defaulted on rent due before the new tenant moved in, and rent of £350 included in the above rent receivable figure for the year was never paid. During the year, Shayla had to replace the carpets in number D4 at a cost of £800. During the year, she also had to replace the crockery at number B1 at a cost of £100, and a replacement roof for number B5 cost her £8,600. No disposal proceeds were received in respect of any of the assets which were replaced. Shayla has loans outstanding on each of the 6 properties and pays interest of £800 per year on each loan. Explain how relief for a property business loss can be obtained. Calculate Shayla's property business loss for the tax year 2025-2026. In this case, if the examiner says business loss, he is not giving you an allowance of determining a profit. So if your computation then ends up in a profit, you need to ask yourself why. So in terms of the explanation on how the relief for a property business loss can be obtained, we actually say that you need to compute the profit or loss as normal. You may do so on a property by property basis, or you can just come up with this single table that shows everything in one place. All right, and you arrive at a loss. Then when you arrive at a loss, what you need to do is that in that particular year where the loss has been incurred, you then have to account it as zero property income. However, the loss will then have to be carried forward to be offset with the first available property income profits. Remember, the relief is in offsetting the future profits. Okay, which means those future property income profits are going to then reduced by the previous year's losses. That's the relief. aspect. Now, when it comes to the computation of the business loss, this has been done for you. All right. So this is what we have explained on part A there. You can read on the screen on your own. Then for part B, the business loss computation, remember we then have to first consider the rents which were received. Remember, as I have already said, if the examiner did not give you, if the examiner did not tell you to use the accrual basis, always use the cash basis. Okay, the cash basis is the default basis. All right. Or if the examiner has told you that if you had calculated the aggregate property income and you discover that it is over £150,000, then you are forced to use the accrual basis. Other than that, you must keep on using the cash basis. So now, these figures were given as rent, the rentals received in the table there. Please do not be confused. The table here is telling us of these rentals which were received from each property. So those are the figures we are adding across, and we were then told that there was a certain rental which was never received. These 350, which is included in the rentals of D4, were never received. They were never paid. So we then have to deduct this 350. We need to remove it from the rentals, and we arrive at the total figure of that one. Then we deduct the the expenses, the allowable expenses. All right. So we start with the insurance, and we simply pick all of those figures. We pick those figures as in the table. Remember, these were the insurance figures: 280, 220, 340, 150, 150, 140. So do not be scared. Do not be scared. Do not be thrown overboard by these figures. Whenever you meet them in your examination, do not be intimidated by them. Always be vigilant, always be strong, trust in yourself. So you can see that it was a very simple question. So that's the insurance, the gardener's wage, the accountant's fees are allowable, the advertising costs are allowable, then replaced domestic items, the 900 here, the 800 plus 100 are all allowable. But let us revise the wording. Okay, so where are those guys which were okay, the cost of advertising was 50 in respect of that one. The new tenant took over immediately after the old tenant. Unfortunately, the old tenant. Okay, so let us read here. Shall I to replace the carpets in number D4 at a cost of £800. This is allowable. During the year, she also had to replace the crockery at number B1 at a cost of £100, and a replacement roof for B5 cost her £8,600. Okay, no disposal proceeds were received in respect of, so these repairs and replacements are all allowable. So we are going to have a table like this. Remember the repairs for the roof there, that's 8,600. So, excuse me. So you add them up, you come to this, and you will see that as long as the expenses are larger than the income, then we are going to result in a loss. That's a loss. So the assessable property income for this particular year is 0. So that's how you earn your marks. I hope, ladies and gentlemen, I have done almost everything that is required for you to pass any property income question in your upcoming ACCA taxation UK variant examination. So, in summary, the cash basis is the king for the examination for this particular exam. All right, interest on residential lets is equal to 20% tax credit. It is not an expense. So it is a tax credit. After you compute everything, after you compute your property, your tax liability, you then have to factor in the 20% tax credit, which is 20% of the interest expense. Okay. Then there is a relief for replacements on residential properties, which would, residential equipment, which would have been replaced during the year. Lease premiums, you need to use the simplified formula, that formula where we said premium. Okay, we said premium multiplied by 51 minus n over 50. That's the easiest formula, isn't it? Yeah, that's the easiest formula. Although you may use the longer formula, okay, you may use that longer, rounding formula. Okay, the other one we said that's premium minus premium. Okay, premium minus premium multiplied by n minus 1. Okay, I yeah no that's minus premium multiplied by 2%. Oh god, I forgot a 2% somewhere. Multiplied by 2%, then multiplied by n minus 1. Let me rewrite it again here. That's premium. Remember, we are computing the accessible amount. The accessible amount, which is equal to premium minus premium multiplied by 2% multiplied by n minus 1. So you just have to pick which method is easier for you, either this one or that one. You just have to pick which formula is going to make your day easier, your job easier. Then there is what is called a rent a roof relief, okay, which is a choice. You can use the £7,500 flat deduction, or you can go for the actual costs which you would have incurred. By the end of the day, you need to pick which one is going to give you the lower taxable profits, because by the end of the day, you just have to manage your taxes. You need to avoid taxes, all right, not to evade but to avoid. So avoidance is sometimes acceptable in the taxman's eyes. Anyway, thank you so much, ladies and gentlemen. And if you are a student to the Acca tutor, obviously you need to do some questions which I would have sent you. Please do those questions within the time frames given, because our start period is time pressured, time structured, such that if you do not do those assignments within a week or within the set time frames, you are not doing justice to the study course, to the study objectives. Anyway, guys, thank you so much. See you in the next video.